All right, everyone. Welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer. The views expressed by my co-host today are their personal views, and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
All right, everyone. This episode is brought to you by our friends at Avalanche. They're the layer 1 blockchain that is fast, stable, and scalable. You're going to be hearing all about them later in the show. For now, let's get into it.
Sushi in 2021, they spent over $500 million of token emissions. That is so much money. And you know, what would happen if they had that money now? You know, that would be a lot more useful in growing their market share. And so I think you keep incentives low, you keep cash flow going to the core developers, and then you wait till the last possible second to turn on the fee switch.
Welcome to Bell Curve. We've got the four of us here back again. This week, we're starting off with a couple of shills.
Permissionless is the #1 crypto conference in blockchain, and last year's Miami event was one of the most well-attended circuit conferences that I've ever seen.
It was in Palm Beach,
DeFi.
but continue.
Yeah, wherever it was. It's a hazy period of time. It was great. And next year, they're doing it in
Austin, Texas,
which is the capital of Texas. And it'll be super fun. So, yeah, sign up now. Get your tickets.
We're both going and excited to attend.
Yeah, you buried the lead, fellas. You guys are both that's the draw here. We got the framework,
we'll both be
guys,
speaking.
Right?
Yeah, it'll be great. It'll be a good time.
Man, we have a VP of marketing role open. I know who is not getting that role.
Oh, man.
The other show that we've got for this week is 1000X, the new podcast coming out of Blockworks, featuring it's Avi who's leading it regularly.
Avi Feldman, yes.
Yeah.
Yes. Mm-hmm.
Avi Feldman will be leading it regularly. He is the head of digital assets at, I believe, Golden Tree, and general crypto native. Exciting to hear more about the market takes from Avi.
And Jonah Van
There will
Borg.
be takes.
There will be takes. They will be had. It's a great episode. It's a great podcast, guys. It's going live on the Empire feed as well. So definitely make sure you check it out. We're big fans of the work.
I honestly did listen to the first half, maybe the first third of it this morning. It's good. I'm gonna enjoy that one.
It's a really good first episode. It is good.
Yeah, very good.
Vance, he also calls you he called you a smart guy. Said he thinks that you know some things in my conversation with him today. So you should listen to it.
Actually,
Vance take that at face value.
Yeah, Vance was not going to listen. Now Vance is definitely listening to it.
Ooh.
Vance is like they're men of culture. They're men of culture. Yeah. Actually, Vance got 2 shout outs on Blockworks podcast. We have a podcast that our analysts do called 0x Research. And there's in the hot seat. So basically someone who's messed up this week. Binance was in the hot seat. And then there's the cool throne for best take of the week. And Vance's L1 tweet thread was the cool throne take of the week. So yeah, man, you got some shout outs.
Yeah.
I mean, sounds like a good place to start. What was this thread?
I think we discussed this.
It was the all L1.
We did.
Yeah, I don't want to beat a dead horse, but it seems like SBF put a lot of client money into Solana, and a lot of these all L1s are valued based on that come up. So could be an interesting year, for those high value private projects. If you raise $200 or $100 million, I saw today that Aztec raised, I don't know who leads your next round, but you're going to have to prove your worth as a public network, which is going to become increasingly harder. So that's kind of my take. I don't think I've gotten a lot of shit for that take too. People have reached out and been like, "You're so cynical. How could you just beat up on the builders like that?" But I feel like at this point we should be trying to not view the past with rose-colored glasses. We should be actually trying to figure out what happened and what that means for going forward. And that was my best approximation of the truth.
I'm worried about getting outclassed in the debate here, but I actually think that Solana is probably one of the better risk-reward bets that you could make in crypto right now. And I'll not financial advice, whatever.
Ooh, that sounded a little bit like
it's not financial advice. Adam, all right, it's not financial advice. You can relax, buddy. But here, let me tell you my sort of thinking on this, and then you can tell me why I'm wrong. But the whole argument of SBF basically, which it looks like he was doing this, right? He was basically selling Bitcoin and ETH, so artificially depressing that price in exchange for pumping up his Sand coins, which you could sort of group Solana in that bucket. But that's not a fundamental argument why Solana may or may not have worth. That's a technical argument, right? For buying and selling over a specific period of time, right? So just because Sam bought Solana doesn't necessarily mean it doesn't affect the fundamental first principles use case for why Solana may or may not be valuable. I think overall, there's going to be demand for what Solana values, which is they've got, the way that they do their consensus mechanism and the composability that I do think that there's probably some use case for what they're building. So I don't know. I kind of think that if they make it through the crucible right now, it's either not going to work or it's going to be a lot more successful than it is today. So that would be kind of my argument.
So follow-up question there. How do you value, or how should you value valuation theories of base layer chains?
I'd say, I guess it's like whatever you can sell the block space for, essentially, right? So it's kind of tough there's like a fee market, right? So it's sort of, I guess that's how I would roughly look at it from a high level.
Exactly, and that kind of equates to revenue. Revenue right. Minus inflationary, which inflationary tokens, you could say that's cost. And so revenue minus cost, profit, is generally how I would say, this is like super simplified, but it is probably how you could value most of these businesses. The other way to look at it as well, the same way to look at it, but another angle is to say, okay, all the different apps that are building on top of the chain, the amount of transactions that are going through in each one of those apps and the amount that people are willing to pay or developers are willing to pay for the transactions going through those apps. So it's basically quantity times price equals revenue. The reason why I think a lot of this comes down to who is actually buying, who is selling, is that there is sort of a halo effect of wealth creation that drives a lot of people to choose one blockchain over another. And the same thing happens on the flip side, which is as you're on the rise and you're seeing, if you're a developer building on top of Solana, chances are you either need to have Solana or you have some in general already. And as you start to see your purchases of Solana, of Sol, go up in value, it has this halo effect where you are now kind of feeling good about the ecosystem, feeling good about the blockchain. It has a reflexive up, but also a reflexive down perspective. And it sounds really simplistic to think about this, but when ETH was priced at $4,000 and some person who wanted to come into the ecosystem and buy, I don't know, like an ETH and it costs $4,000, that price point is actually pretty restrictive. And so I think there is actually some effect of not only prices going up, but whatever the price point is, being really important as to how you should value, these ecosystems, because the value of the ecosystems is the leading indication of how many apps are building on top of it, where developers are going, will ultimately translate to revenue. Anecdotally, there's just a lot of people that are pulling away from Solana for a number of different reasons right now. And so that kind of leading indication is sort of the reflexive down.
I want to get into this idea modular versus monolithic blockchain. Ultimately, I think most blockchains end up being modular, but I think it's a valid thesis, I think, to have some use case for monolithic blockchains. But if I just close my eyes and I'm how do I think this is ultimately going to play out? I think the big challenge of crypto is trying to scale throughput while maintaining security and meeting demand. That's the challenge that crypto blockchains ultimately have, right? They are kind of deluged by this unbelievable increase of demand, and some of that spills over into these alternative layer one chains. I think ETH's roadmap is ultimately a good roadmap, but it's not going to be able to scale proportionally with these insane waves of demand that come into crypto. Just by virtue of that alone, I just think there are going to be other layer one blockchains that end up succeeding. I also kind of think some of this probably is just, and honestly, the other thing too is I think one lessons that investors might have learned looking back at this last bull run is that the only thing that is still really investable in crypto is layer ones. I do not mean this in any way offensive. The DApp builders you guys are fucking awesome. And ultimately I think DApp should be more valuable than the layer ones they're built on. But guys, we've shown this chart before on this podcast. Look at all of the dApps on ETH denominated in ETH. It's down only charts. So I think what a lot of investors might have looked at is been look, dApps are just uninvestable at this point, because you could just buy the layer 1, and history tells us that the layer 1 is going to return more than the dApps that are built on the ecosystem, and they're the biggest and most liquid investments that you can make. So I don't know. I'm kind of looking at all of these things and being like, I think there's a decent chance that Solana makes it here. And it's like, okay, if you put some money in and you lose it, it could go to zero. But like, so many people are so bearish on Solana at this point. It's kind of like, what do you make if you're right, and what do you make if you're wrong? And I think if you, I don't know, that's sort of the way that that would be my attempt to steel man. Because I agreed with a lot of what you said there, Vance, as well.
I mean, just like on the topic of dApps, this week actually there became a new #1 by TVL dApp, Lido, and this thing is just inhaling ETH, and it's just stacking ETH, and pretty much all of the charts that you look at for its revenue are up and to the right. Like, there are some apps that are really starting to demonstrate their value even in a bear market. I don't know if the lesson of last market is you should invest in the all L1s. I think it's more so like, we need to prove out product market fit and use cases on the dApp level, or else we're going to be circular forever.
Mike, what I would add to that, to your discussion, and I agree, like, on par, on the face of it, all of that is absolutely correct. The one variable that I'd add to all of this is modulo valuation, where the value of what you're buying something is a major component of how you can view whether or not, like, buying right now, buying in 6 months, buying 6 months ago would have been a good idea. And value, once again, comes down to valuation. Is this a good value investment right now? Even if it's down 90%, it could still go down another 90% before it hits zero. Like, the value here is a very, very important thing. And I think that gets overlooked, because all of these have different, if every single token project, if every single blockchain had the exact same number of tokens, we would be able to evaluate based on price. But nobody really thinks about, like, what's the market cap? What's the fully diluted market cap? How many tokens are left to be unlocked? What's the unlock schedule? Like, those are all things that need to be put into the evaluation of when to buy or when to not buy something. And I don't think that happens enough, and I wish it did.
I think you're totally right. And by the way, at some point, I would think that, like, dApps they should be like higher beta to whatever L1 they're built on. I would think that that's the way that it should work, right? Because they're slightly riskier, right? So you're taking more risk. Investors should demand a higher return, and they should be like high beta. So like Lido should basically be high beta ETH, to like way oversimplify. But you sort of combine that with whatever revenue and like their discounted cash flow, I guess. But it doesn't really seem to perform like that today. So I hear you. Like, I'm also on the train of, like, we got to build stuff that people want and charge fees for that and actually build sustainable businesses here. But I could definitely also see, with my, like, slightly cynical goggles on, I could also definitely see investors taking, like, the other side of that.
The three businesses that are working right now: selling block space, trading digital assets, and staking. That's basically the only things that have, you can point to multiple options of them that have over, tens of millions of dollars of revenue.
Yeah. I feel like on-chain, like, perps is like a pretty good, like GMX and DYDX also. Again, not financial advice, but I think those are pretty interesting.
This is the financial advice section of the podcast.
Can we talk a little bit about, I know we've talked a lot about SBF in general, but his trial, he got arrested this week, right? So again, so he was actually supposed to testify in a hearing on the 13th, right? And we get a tweet out the day before that he's been arrested in the Bahamas and is now currently in Fox Hill, which is one of the top 5 apparently worst prisons in the world. I don't know. I'm not necessarily a fan of SBF, but I also just think from a humanitarian standpoint, like, no one should be dumped in horrendous situations like that. And I don't think it's going to be celebrated.
They apparently contacted his family and let him know that they're not actually infested with rodents anymore. So at least
cool.
At least Fox Hill is a little bit better than when it was reported.
There's kind of this interesting story of this guy. His name's Victor. I think it's like Ozenki. He's a Czech-born businessman. He allegedly went to Harvard, and he perpetrated like a few large financial scams. This is like in the 90s. Or no, it was like 1999, like 2000, that time horizon. And he bought Irish citizenship when they had like a pay for passport program. And once he committed these frauds, he fled to the Bahamas. And in the Bahamas, he was arrested and put into Fox Hill prison. And he fought extradition. He didn't want to go back to the U.S. He didn't want to go back to Czechoslovakia. So he fought extradition, and he was in Fox Hill prison for 3 years fighting extradition. I think it was from like 2005 to like early 2009. And he successfully fought extradition, and now he is effectively confined to the Bahamas. He's no longer, in legal trouble at all, at least in the Bahamas. He's still wanted by the U.S. and Czechoslovakia, but he fought extradition. He kind of lived to fight the other day. And, the kind of trade-off that he made was, I'll spend 3 really bad years in Fox Hill for a lifetime of freedom on the outside. I wonder how much SBF is studying that guy and being like, A, how do you survive in Fox Hill? And B, like, what is the calculus? Like, do you tap out that Fox Hill is bad enough and you just get extradited? Or do you try to fight it and stay in the Bahamas and potentially get some sort of lighter sentence in the case of Victor, whatever his name was? But I thought that was a very interesting historical precedent for what's going on.
The other historical precedents that I was looking up over the course of the week is, as the indictment or whatever process was unsealed, you actually got to see what charges were being brought and how many of them were and where they were coming from. SEC, CFTC, and I guess apparently the DOJ is still working on other potential crimes as well. But the Southern District of New York has filed the charges. It's 8 counts. If all of these counts are reached at the maximum level, what you're looking at is 165 years of prison, which is actually more than Bernie Madoff got. So don't expect that there's going to be that level of time that is served. On the flip side, you have Elizabeth Holmes, who perpetrated a $121 million fraud against her investors, and that was what she was committed. That's what she was found guilty of. $121 million of fraud against investors equated for her to 11.25 years in prison. The levels of fraud that we're talking about here, and at least in the charges that were unsealed, is to the tune of 1.8 billion. So these are massive in relation to what was just happening with the Theranos case, but they're also against lenders and they're against customers. And so I think the narrative of who this person is and how they're viewed, like the court of public opinion, it's going to absolutely sway against him. The other thing that I found in reading those indictments is it's very obvious that someone is talking. Who? We don't know. But it's not possible. It's not likely or reasonable to assume that they have this level of detail without sworn testimony, witnesses, and someone on the inside who knew, who's probably talking right now. So
I mean, it just started coming out that folks are talking. Like, what's the guy's name?
Ryan Salami.
Ryan Salami. Right. Ryan Salami went to I think it was the Bahamas authorities and told them that he may have been committing fraud. That SBF was committing fraud by he told them the story. It sounds like so. And this is how it goes, right? They say, oh crap, I'm facing 50 years in jail. Let me get out of that. Say it was all SBF, and
But also, Ryan Salami seems to be doing the right thing. So there's definitely good people that didn't know about this, seemingly that were higher up. And I think that shouldn't be lost. These people
that's how it's supposed to work. Is that
right.
People come out and share the real story.
But I think that gets to the point of how contained this information was at the highest levels of FTX.
But I think we know now. After that, they said. I think one of the interesting points is that only 3 people at FTX had the required passwords to transfer funds to Alameda. It was, and this was, I think, according to Salami, it was SBF, Nishad, and Gary.
Gary.
Yeah.
Where's Gary?
Does Gary exist?
Where is Gary?
Does Gary exist? Is this all a fever dream?
You can see the back of his head.
So the other take that I had, and this one's maybe just more because I share a similar hometown to SBF, that listening to the whole thing with his parents and hearing kind of the backdrop of what they were going through, what their reactions were in real time in the courthouse, and just the backstory of what they've been doing over the last few years with FTX. I think this is representative of peak Silicon Valley, hyper woke, hyper liberal, hyper elitist parenting. And you think about it. You've got SBF, who obviously the child of the product of two Stanford law professors, goes to an elite, high school. Obviously, MIT is super smart, super educated, and definitely has a lot of the same political leanings as his parents, and isn't very well rounded. Is hyper focused on this one category of the world. Uses as in his words, the woke perspective to shield and conceal what he's actually intending to do. And historically in Silicon Valley, you've had this very hyper liberal, hyper educated group of parents that have been overbearing on their kids, and it's been kind of boiling over and getting crazier and crazier over the last couple of decades. I would say it wasn't the case for me in my experience of living there, but just hearing, I have two younger brothers, and hearing about what their experiences were like, or what their friends' experiences were like in Palo Alto, it really is like calling into question this entire like parenting and how do you raise a kid in this example and situation. It is I don't know. That's been one of the takes that I've had over the last few days, just listening to all this.
I only skimmed that article basically, but I saw, when he was referred to as being a fugitive, his mother, quote, audibly laughed in the courtroom and stuff. To be honest with you, I didn't even have a take. Is that sad or is it confusing? I really didn't know what to think.
I mean, they're probably in shock.
Right.
Just like, have gone fully to the loony bin, temporarily as they deal with this.
I have some empathy for the family situation. To be honest with you, like, I don't know. I've heard and I understand how it looks. I get it. But I also sort of think you have a huge blind spot when it comes to your family. And it's like, hey, I've got this son who raised a bunch of money from a lot of like other people. He clearly fooled other people as well. And, his family it's now been sort of intimated that he was opening doors for him. And it's like, well, yeah, now that it turns out he was an enormous fraud and lying to everyone, that looks really sinister. But also, let's say he had actually been what he was representing publicly to the world. And let's say your parents give you the benefit of the doubt. Wouldn't you try to help your kid do these? I don't know. It just wouldn't have looked quite as sinister. Maybe I'm extending way too much leeway here, but when it comes to family stuff, I always maybe give people passes when they don't deserve it. I don't know, but I don't know. I'm not in the cool throne.
Let's see if they were actually on the take.
Yeah.
Like I'm very much there for like the, they didn't do anything wrong, but they may have.
All right. There was some interesting. Okay, I have another question for you guys. So Sam got arrested. You said 8 counts, right? It was basically everything that you might have hoped that he would give. There was wire fraud, conspiracy to commit wire fraud, securities fraud, conspiracy to commit securities fraud. There was money laundering there. They threw the book at him. But they also threw the book at him one day before he was supposed to testify publicly in front of Congress and everyone. What do you make of that?
Honestly, I think it's nothing burger.
Nothing burger?
The timing of it, sure, in retrospect, is suspect. But you saw his testimony. We all read his supposed testimony that I think Forbes published. He was just gonna placate and pander and say, "Hey, I don't have all the data in front of me, but like, let me tell you my side of the story, and here's what I remember. I do not recall. I do not recall." Like, it was just gonna be that whole dog and pony show. I think you wouldn't have been able to get him to stick to anything or really like truly answer something that would have been more incriminating than basically Andrew Ross Sorkin was able to accomplish. And because of that, like, I don't think that there's that much value. The indictment was filed, I think, the previous Wednesday and then was officially issued the Friday. So like, the timeline here isn't like we got this thing in within 24 hours so that we could stop him from testifying. It's more so that like this path was happening, but it wasn't something that we could really stop, and it just happened to land the day before he was supposed to testify. But I don't know.
Wait, this is how he was planning on starting his testimony.
Oh my God, this is so bad. He's such an idiot.
I would like to start by formally stating under oath, I fucked up. That's the opening line. It doesn't get much better. It's just like, dude, come on. It's pretty classic. pretty classic Sam, though, I think. There actually was one pretty interesting tidbit. So John Ray, the Enron guy, also testified, and I think he shed some pretty glaring light on stuff that people had suspected for a long period of time. So it's not really news to people who've been following this podcast or deeply plugged into crypto, but Alameda did have an enormous exemption, right? They weren't, their liquidation on FTX had been turned off. They shielded the Alameda losses by moving it into an account titled Our Korean Friend.
The weird Korean account.
That was wild.
Some
that
of
was
this,
hilarious.
you kind of have to laugh at a little bit. Here's one thing that I thought was actually pretty interesting that didn't get an enormous amount of coverage. So apparently there was a blog post that was penned by Sam that was going to be released in September, which is we came, we saw, we researched. So that was going to be a blog post that was announcing the closure of Alameda back in September. So, there's a lot of different...
I'm not surprised, honestly. The secret to their success, the secret ingredient was crime. And then when they ran out of, basically user balances, the ability to stop hunt people, special exemptions that they could move around, obviously then your next step is okay, how do we wind this down? But at that point, when you have a negative, $4 or $5 billion weird Korean account, it's just over. You can't do anything.
Well, so one of the questions that I have is okay, let's say they were able to accomplish shutting it down. What would that actually look like, and how would that materially have changed the outcome of the events that happened over the last 3 months? One of the ideas that I had is they probably would have been able to conceal a lot of the losses within Alameda, and you would have been able to So yes, Alameda had trading capabilities. They had a bunch of losses, but they probably would have been able to shift, money from right pocket to left pocket to right pocket. I think you would have been able to fill a lot of the hole of FTX, but then it just got to be so big, and then when FTT bottomed and all of that, it just got to be too much. But thinking back to where FTT was in September, there's a possibility that this could have at least been a better outcome.
How though? There was the pile of money that they lost could never have been that big because it was a prop fund. They didn't take outside capital. So
I've got a question for you guys. Did you see that they lost? Alameda posted, or SBF through his combined entities posted a loss of $3.7 billion in 2021. I looked at that and I was like, wow, that's a really big number. But how did they even lose that much? They didn't raise that much money. How did you even post a net loss? Even if it's just a loss that's realized on paper, shouldn't there have been a gain? All the gains came in 2021. How could you have posted that loss in 2021?
There's one explanation for that. The one big drawdown in 2021 was the summer, right? That's when you could have theoretically lost a lot of money. And if you look at the market, there's two peaks in 2021. There's this organic peak around when Elon was shilling Dogecoin on SNL, and everyone was Saylor was going to get nation states to put Bitcoin on their balance sheet. That was the organic top. Then it died in the summer, and then there was the futures ETF run for Bitcoin where we kind of ran it back turbo. My hypothesis is that they blew up shortly after Elon went on SNL, and then they tried to make it all back by doing this degen gambling, trying to force a revenge pump on crypto, which kind of worked, but then they somehow got out over their skis again and got hurt more. But the only time that they really could have blown out was the summer.
In both summers. I mean, I think they got really pretty badly trapped in Luna. And
no. This is just 2021. I know. Just talking about those losses.
I'm saying both summers. The only way that you would have been able to realize multiple billions is if you lost. But then the other way that you can do this is you realize the loss. There's no tax loss harvesting rules in crypto, and then you can rebuy at a lower valuation. And then when you pull that out and you use that as collateral, so then you say, okay, I just rebought all this Bitcoin. It's at a lower cost basis. I realize the loss, and that's it. My cost basis is now at whatever it was, 20K at the time. I'm able to actually go off and use it as collateral, which is not a taxable event when I pull out cash against that collateral to then go off and trade. And so I think that's probably what happened. But, it takes some maneuvering from a tax perspective. I'd be very curious to see what their expected financials would have been for 2022. But to just go back to it, the reason why I was saying Alameda could have concealed a lot of the losses is because they could have taken bad debt expense for Alameda and basically just like not paid back their loans. And so you probably would have been able to conceal and contain a lot of the FTX consumer losses if you just like basically had Alameda go insolvent and bankrupt.
Got it. I'm gonna move us past FTX.
Yeah, I'm putting SBF in my 2022 rear view.
I think that's a good idea.
I'm done with his ass. He's gone.
Now there are some interesting still implications of FTX. Like there's still a little spillover, right? Like there was some new stuff that came out with Genesis, it looked like, and then obviously I don't know how much Mike and I should talk about the block, but like, you know, another media company was taking money from Sam. So maybe one of you guys want to do that story justice, just because Mike and I have a little, yeah.
I'll do the block. Yeah, I mean, looks like the CEO had taken a personal bribe from Sam and not told the company, and the circumstances surrounding the actual sale of the company are pretty murky, but our base case is that like nobody else at the block basically knew. Frank, Larry, the rest of the people. I think this is just like a case of massive wrongdoing for just the CEO basically. And now the question for the block is, it's all like, you guys respect the block, obviously you're competitors, but like they are a solid crypto journalism outlet. Frank's great, Larry's great, the rest of the team puts out a lot of research, but the organization was huge. And I think they're going to have to, you know, potentially right-size themselves. They're going to have to focus on whatever's generating revenue, because I think they kind of had just like carte blanche from SBF and the funnel of loans from him. But I think they're, you know, good people. They're going to make it. It's just going to look a lot different. And they're certainly going to be, hopefully, like a little bit more, I mean, they've always been pretty good investigative journalists. I think this was just a blind spot for them. And so maybe just like a redoubling of like, okay, who exactly is in this ecosystem? Who's, you know, potentially nefarious?
All right, everyone, quick break from this episode to talk about our show sponsors, Avalanche. Many of you know Avalanche as the fast, reliable, and scalable layer 1. The folks at Avalanche have a really great message for those of you who are in the crypto industry right now, which is bear markets are for building. So while a bunch of our friends over in CeFi are kind of going through these struggles and travails, the folks at Avalanche have basically put their heads down and are shipping products that builders want. The latest solution? Elastic subnets.
Right. And just to expand on that, Avalanche is consistently upgrading all of their platforms, right? So on the platform side, you've got Elastic subnets, you've got new VMs. On the infrastructure side of things, you've got Core, which Mike, I know you used that the other day.
I was a bridgeor.
Yeah, exactly. Exactly. So they're upgrading the infrastructure side with Core and Enclave. The chain has had like no downtime, super customizable for devs. Yeah, if you're a builder, avax.network, avax.network, great place to be.
But do Yano and I as well. So you definitely go check them out, but click the link at the bottom of this episode.
Click the link.
Otherwise, we're not going to get any credit. Come on. Yeah, click the link at the bottom. All right.
Give us the credit. Exactly. So yeah, big thanks to Avalanche. Yeah, you just had a great experience with them the other day on the user side of things. So
go check them out, guys. Thank us later. Let's get back to the show. I've got a question for you just in terms of, you know, could be for the block, but it also could be for basically anyone that took money unknowingly, sort of, from FTX and SBF, right? I mean, is there like usually you raise debt from someone, then you got to pay them back plus interest. But in this particular instance, the guy that you theoretically have to pay back plus interest to is bankrupt and in prison. So how does that look? I mean, does that end up getting clawed back by some sort of bankruptcy court, or is it kind of just like, hey, you kind of got away with this because this person's in prison? I'm not a lawyer here, but how do you think that works?
It would have been cleaner if it was an equity investment. In the bankruptcy process, you're basically selling assets, you're recouping whatever you can get, and then you're distributing cash from the estate. And the estate is the person who's managing out like the shell. John J. Ray is the estate manager for FTX. For loans, that's another category. You know, those are things where you're sitting in a bankruptcy proceeding and you're saying, what assets do we have? Well, we have a bunch of loans out to people. What are our options for recovering that loan? Well, we can force them to pay it back and like go after them, or we can sell it to debt collectors for pennies on the dollar who are going to go after them as well. But like the common denominator here is that like you have someone coming after you for the money. And in this case, it looks like McCaffrey is going to be that person. It's not going to be the block. McCaffrey mechanically was the one who received the loan, and then he went off and spent, you know, whatever it was to, you know, use that money on. The bankruptcy creditor, the bankruptcy estate is not going to go after the block. They're going after Michael. Michael's problem is a different one. like you had these loans or this equity purchase of the block, he will then probably have to sell that to try to make whole the creditors to the extent that he can.
So just to be clear on this, there were 3 loans that were given to Mike McCaffrey. The first one was $12 million loan so that he could buy out the existing owners of the block when he took over as CEO. The second one was a $15 million loan given to his holding company. All 3 of these were given to his holding company to be able to have operations expenses for the block. And then the third one was so that he could have a penthouse in the Bahamas. All of those went to his holding company. And I would imagine that the holding company, therefore, is the owner of the equity of the block. And so, not only is it sort of like got to chart a new path for the block going forward, you're probably going to have to restructure in a certain new way. And then it's a question as to like who stays, how does it work? Negotiations with creditors is going to be the thing that takes a really long time. But this is going to be one of those negotiations, and that holding company is definitely one of the debtors.
Well, I think, if we have a take on it, it's like, honestly, our heart goes out to the people like the block. I know they're a competitor of ours. They do great journalism, and it really sucks for the people that have been putting their life's work and their reputation into building something that stands for integrity. And I think it still does. But, to have this sort of smear on it is like totally unfair to the people that I think did super good work there. And
wholeheartedly agree.
Yeah. So heart goes out. It's a crappy situation over there for sure, but I'm sure they'll be okay. Do you guys want to talk about Sushi governance? There's actually something pretty interesting going on in that world. All right, so there's a proposal. So Jared Gray, for those of you guys who don't know or might not have been following this, there was a pretty big, relatively hotly contested governance vote for who is going to be the new head chef over at Sushi. And this guy, Jared Gray, won. So he made a proposal earlier this week, basically to redirect funds into the Sushi treasury, right? So I'll just read you here what the proposal is in his words. Over the past 2 months as head chef, I've spent most of my time analyzing the operational and budgetary expenses and liabilities to ensure the project's long-term success. After reviewing expenditures, it's clear that a significant deficit in the treasury threatens Sushi's operational viability, requiring an immediate remedy. In my original post, Sushi operated with an annual runway of $9 million US dollars. However, after my detailed review, we've reduced that requirement to $5 million US dollars. We made the reduction possible by renegotiating infrastructure contracts, scaling back underperforming or superfluous dependencies, etc., etc. However, as previously stated, Sushi is currently near full distribution of its token supply. This is important. We'll get back to this. And has yet to capitalize on opportunities to diversify its treasury and provide necessary liquidity for ongoing operations. The treasury currently provides for 1.5 years of runway. Therefore, the situation requires immediate action to ensure sufficient resources for uninterrupted operation. So I propose, I'm skipping a little bit here, I propose setting Kanpai to 100% of fees diverted to the Treasury multisig for 1 year or until new tokenomics are implemented, helping return Sushi's fiscal resources to the competitive level. An additional benefit of Kanpai's solution to the Treasury is the diversification of assets, which limits the need for market selling Sushi, which is a net positive for stakeholders. In addition to Kanpai's revenue, the Sushi team increased its funding by securing several multi-million-dollar partner deals. Yet relying on business development deals is only part of the successful business model to secure Sushi's future. Do you guys, I've got some sort of thoughts on this, but what is your high-level take about this?
So $6 million to run this organization is very cheap. I think it's the first thing. If you look at the actual line items of the salaries, that's kind of what people, most focused on. $500K for the CEO, $400K for another person, $300K for a few engineers. That is expensive, but this is not a traditional technology job. You were taking on substantial risk by running one of these organizations, and if I was him, I would probably be wanting that much as well. Sushi's cheap to run. It's $5 million. I was looking up MakerDAO's last quarter expenses, $13.5 million. So it's 3x the cost to run Maker for 1 quarter that it is to Sushi for a year. And generally where we want to see DAOs, DeFi DAOs, and there's a lot of them, if you're small, 5 million makes sense. If you're big, 10 to 20 million makes sense. But that's generally the range of acceptable inputs. I think you're going to see a lot of this, ooh, we've minted all the tokens, we've given them all away, it's time to redistribute the wealth. You're going to see a lot of token migrations. when Lend did a token migration to Aave in the last bear market, that was to solve a lot of the problems that are endogenous in this proposal. But this is kind of what it costs. And I think people on the Sushi token side, the community, are pissed about, well, the whole thing about Sushi is that you're going to give fees to the users, and Uniswap doesn't do that. And now you're having to double back and say, like, okay, we need to actually recapitalize the treasury for this to keep going. And I think the answer is just like, do you want like more of a much smaller pie, or do you want this thing to actually like live on and grow and succeed? And the go-go bull market, everybody just wanted tokens and yield, but now it's like you have to opt in to double down on this organization because there's just not going to be the same level of fee sharing that there was a year ago. The economics just aren't there, and it's just part and parcel of the whole deal.
I think to reiterate everything that Vance said, kind of aside from the operations and the operating costs, I think one of the more interesting things here is just what happens with long-term versus short-term token models. And if you have the long-term perspective of what this token is, where it'll be, and exactly where it's going to be in 5-10 years from now, you're probably going to be wrong. And so what you need to implement, I think, is usually some sort of like inflation schedule, some sort of change element that can be implemented. I think it was Wi-Fi, Y-Earn, that minted an additional 20% of tokens to give to the core developers so that they were incentivized, because remember, 100% of those tokens went to users of the platform, not the people who were building it. So like you have to have the right incentive structures to be able to persist these in the same way that you would a technology company. And the problem that you have with token models is that when you have a token and you give 100% of it away, 100% of it is gone. When you have an equity in a company and you have 100% that's gone, next time you raise money, there's also an additional re-up of the employee stock option pool. There's additional shares that are created. So you're always increasing that 100% when you do subsequent financings for companies, and you just don't have that mechanism with tokens. And so there isn't a natural point where you have the same corollary with companies. And so I think people are going to have to figure out ways to do that.
All right. Can you comment on so that exact observation, right? So Sushi basically distributed an enormous amount of tokens, right, to its community. Same thing with Jurrien, right? But the way that works in equity, this is a little bit of a funny thing that I think you could make an argument that it sort of comes over from Bitcoin, because the meme of Bitcoin is 21 million hard cap, never going to be another one, fixed supply, yada, yada. And that sort of got borrowed, right? Because Bitcoin was the first one that did it. That makes sense for like a hard money commodity store value type thing. I don't think it necessarily makes sense for a lot of these protocols and the way equity financing happens, which is you issue new tranches of equity every time you raise a subsequent round of capital so that you have a smaller piece of a much larger pie. It's kind of a better way of doing it for a lot of these. I mean, do you have commentary on just what do you think about that? I'm sort of looking at it being like, why do we do it this way?
I think if you're going to have a finite supply of the tokens of your protocol, you should have like a finished version of the product in mind. Is it going to take a year to get there? Is it going to take 2 years to get there? But like at some point, you need to kind of take your hands off the wheel and be like, we're not actually governing anymore. This is just done. And like that's the model that works with having a finite token supply where you can't have any more, and you're making decisions that are supposed to be not reversible. And I think like a lot of projects are getting there. Like MakerDAO doesn't need inflation, Lido doesn't need inflation, Uniswap doesn't need inflation. Like they're kind of like finished products, and I think that's why that works. But if you're building something that looks more like a company, where you're pivoting the product, you're releasing new things, you're doing this, you're doing that, you're doing the other thing. Like just like equity, you're going to need the ability to inflate your supply, to pay people, to keep operations going, to raise more money. And so like I think we just had this mental model that we copied from Bitcoin, but it doesn't actually work in all kind of scenarios. But
I'd actually test that. So I think every single private round of any equity financing, usually for a technology company, has new class of stock and new refresh of employee stock option incentive pool. What I think also happens with publicly traded companies, I don't know the number off the top of my head, but last I checked, it was somewhere between 2 to 4% of stock-based compensation for mature publicly traded companies happens every single year. So there is a natural inflation for like products and services that are done, because you still have to incentivize people to continue to maintain them, to work on them, to make them better. You know, even like Yahoo back in 2010, when it wasn't absolutely, you know, doing anything, it still had to pay people in stock-based comp to be able to get people to show up every day and keep the lights on. And it's not the exact same with the protocol, because you put it out on chain and it exists there into perpetuity and users pay the cost of operating it. But there is an element of like, if you are 100% deployed with all of your tokens and you can't do anything else, that literally means that it's over and it's done. And I don't think any of these things are really even close to getting there. Even the Lidos and the Uniswaps and the Mators of the world, I think that they're close maybe to having the product that they want. But if they wanted to change anything, you know, how do you get people to do that?
If you're going to have a decentralized protocol, both in terms of upkeep and governance, at some point it has to be done. You can't keep going back to the well. Like, that's why Bitcoin is powerful. That's why Bitcoin only has 21 million. It's like, it's done, it's over. Like, and that's my vision of a decentralized protocol. And even in Vitalik's roadmap, he's like, in 5 years, Ethereum is going to be a finished product. We're not going to have to govern anything more, maybe a couple of EIPs here or there, but like, we're not going to need the Ethereum Foundation. We're not going to need all these discretionary tokens. Like, I think that's where these should be going, at least.
Do you think, because the way that I would sort of view it is like, it's all about the return that you're getting for that inflation, right? So, Michael, to your point about, okay, so you inflate by 2% every year. Is that good or is that bad? I don't know. What did you get for that 2% inflation? Because if the workforce that you use to procure that, you know, with that additional issuance makes the value of the company go up 5%, then congratulations, you had like 100% return on that inflation. So for me, it's less of a like, is inflation good or bad? It just depends on what you're getting for that inflation.
100%. I mean, we talked about this when we were talking about the valuation model for base layers. It's what's the revenue and subtract out the net inflation. And that's basically how you get to like net profit, let's say, for a decentralized protocol.
I also think one other little bugaboo is this idea, and we had Chris Berninski on the interview part of the show this week, and he, I think, put it pretty eloquently. You know, we talked about when is it appropriate to basically return funds to token holders. And there was this whole kind of emphasis on cash flowing protocols for a period of time. And that was always the appeal to Sushi, right? That you got paid out, basically. And there's this idea that when there's a bear market, well, everyone's like, well, hey, I'm already down 90% on my token here, right? And what, now you're going to take away my payment too? It's like, well, yeah, dude, but you could be down 100%, you know, if you're not careful. Like, things have to be sustainable. And the other thing too is like, I take your point, Vance. At some point, these things need to be finished, but I would argue almost nothing in crypto, with the possible exception of Bitcoin, is finished. You know, I mean, so before something is finished, why are we returning funds to token holders as opposed to reinvesting that basically for labor? Yeah.
You shouldn't be. You should be waiting as long as possible. You, like, start with the assumption that these markets are far larger than we can even anticipate, and that market share is the most valuable thing if you look at a discounted cash flow in 10 or 20 years down the line. Everything that I would, guess would be keep internalizing the economics, keep improving the product, keep trying to get it to a finished point, and then at some point maybe you can start returning cash flow to token holders, to the DAO, to whatever. But if you don't get that market share, it's not going to be worth anything. And you can see the reverse where you spend your wad of tokens too early. And Sushi in 2021, they spent over $500 million of token emissions. That is so much money. What happened? What would happen if they had that money now? That would be a lot more useful in growing their market share. And so I think you keep incentives low, you keep cash flow going to the core developers, and then you wait till the last possible second to turn on the fee switch. And then that's how you have the parabolic, okay, Uber started in what, Michael, 2005, 2004, 2009? Have they ever paid a dividend? No.
But
it's been a decade. I think that's the right time scale, at least a decade.
The other example,
Ethereum, the same thing with EIP 1559 and the merge. Started in 2014, 2022, 2023. That's the first time they ever talked about giving people money for holding Ethereum.
The other example that I think about, I don't know, I was living in San Francisco in 2013 through 2017, and that was the heyday for startups basically paying you to use their products. and it would be like you get your dry cleaning basically like 90% off, and they, you know, this company Rinse would literally walk up and give you a cookie every single time you got your dry cleaning delivered, and like, you know, some guy that you got to know, like you had this like Sprig concept, which is basically like, you know, DoorDash before that blew up, and it would like deliver you like lunches, and like there were all these things.
All the free Blue Apron meals. Remember those? Those were awesome.
I got lunches for $3 a day when I moved to the city.
remember this. You did. I remember Yano did this actually.
And
I mean, Uber.
It was subsidized.
Uber
lunch.
Pool.
Yeah.
Uber Pool usually literally would cost $3.20 to get across San Francisco.
Yeah.
Like
Uber,
there were
Uber
just
was
these.
$5 anywhere in New York. You
I know.
go like uptown
Yeah.
to Fidei at $5. Yeah.
Dude, it's like
So-
$70 now. It's so expensive.
Yeah. So think about that, and think about the correlation between that and everyone who has overspent on their marketing budget, equivalently with tokens or with emissions, whatever you want to call it. And sure, maybe some of those implemented, gains in market share, but I bet 99% of them did not work out, and most of those companies are probably gone. And I know most of them, the ones that I just listed, are. It's the exact same thing. If you spend your marketing budget too soon, or if you use it frivolously, and you don't maintain that market share, or it's not good spend, you're not going to last long.
Yeah. I also think that there were some bad lessons that were learned in this era of like easy money and money printing and blah, blah, blah. And like share buybacks, like all of this is a question of like, where are you in the life cycle of the company, right? Share buybacks make sense when you can't more profitably allocate that capital towards like organic growth, like R&D or acquisitions or something like that. And you're like, look, I don't really have any good investments on the horizon. All the returns are below the cost of my capital anyway. I'm going to give this back to shareholders by buying my own stock back. But I think what that has morphed into in this like wacky last 2 years is, yeah, we should buy the stock to support the price. Like that, and a lot of people took that lesson away and put that in and used. I see some of people talk about this in crypto land like this, like, yeah, go out there and like market buy the token. It's like, what are you talking about, dude? That is a poor use of capital.
Yeah. First of all, market buying a token right now, you're just not going to make any impact. Like you just don't have the size to do it. The reason that it worked when Carl Icahn, there was this legendary meeting where he told Tim Cook to start buying back the Apple shares. Like they had like billions and billions and billions of dollars to do it. But like this is not just a company thing. This is how the stock market works. This is what investors want to see. When you look at a stock and you're an institutional investor, one of your main questions is, what are the buybacks like? What are the employee stock compensation like? This has been institutionalized, and it's not going away either. Like people are very quick to write the eulogy of like, oh, free money and how bad it was and how stupid we were and how it's never going to come back. But like the 10 years at like 3.4. Like the average 10-year yield from 2010 to 2020 was 2.1. Like we're not that far away. Like it's not like we've gone to like 8 to 10% yields, flogged ourselves and been like, we're never investing in technology again. All of this stuff is still built in the stock market. All of this stuff is still coming back. I think we just have a little bit of a hangover from like a little too much, a little too soon. But
let me also add on the stock buyback part in particular. That's not necessarily just like a 1-for-1 or like we're doing this or we're doing that. Like we don't have anything to invest in, therefore let's give it back. It's part of a cohesive strategy and a cohesive plan. But also, the reason why you buy your stock back isn't, it can be to support the price, but usually what it's for is that adds to the treasury stock that the company then owns, and you can give that out as stock-based compensation. And the ability to say, okay, like we are adding to the coffers of the company, we think that our stock is relatively undervalued right now, is usually a good sign with a stock-based or stock buyback, because they probably know the internals of the company just as well as the CEO, and they're able to tell whether or not the stock is undervalued. So I think there are multiple reasons for stock buybacks, but it is part of the options and the plethora of things that you can do as a company.
I would have more sympathy for that argument if companies weren't absolutely fucking horrendous at deciding when to buy their stock. Like you can look at all this data. They buy the top and they sell the bottom, except for one guy, John Malone, who's like famously good at this. Yep. He's a sort of telecom tycoon who was really, really good at buying his stock when it was low and issuing stock when it was high. And
is he the T-Mobile guy?
No.
What
happened to that guy?
He rolled up.
Cable Cowboy.
Still kicking.
Still kicking?
Yeah.
I miss that guy. Used to watch his like Sunday cook-offs.
I think John Malone is now the largest landowner in the entire United States.
I believe that's correct.
It's either him or Bill Gates or Ted Turner, or maybe
Ted
those
Turner
are the top three.
You know, it'd be very interesting. I wonder if anyone. I'm on Yano's recommendation. I'm watching this documentary on Rupert Murdoch. It's on HBO. It's pretty good. Empire of Influence. And my mom actually just read the Ted Turner documentary, and their lives, you know, supposedly as guys on the total different ideological spectrum, there are mirror images of these in a lot of different respects. Yeah, I've just
used to be wild back then. Like,
same with John Malone, by the way. All three of them. So I watched this Rupert Murdoch documentary, and then I read John Malone's biography and Ted Turner's biography. They're all like these media tycoons. They just bet the farm over and over and over again for like 40 years in a row. Like every 3 years, they make a bet the farm decision.
So much survivorship bias in the biographies that you read versus the ones you don't.
Oh my God, yeah, 100%, 100%. And like people just told these guys like this is a bad idea. There's a low likelihood of success for minimal outcomes, but they just kind of rolled the dice and it ended up working for a lot of them.
They also both
let's talk about 2023.
Yes.
All right.
In what sense? What do you want to talk about?
I don't know. How are you guys feeling? I
have a question for you, Vance. Are you this is not about 2023. Are you guys buying? So we just started seeing like the venture stuff at like 80% discounts, like some of these later stage stuff. Do you guys buy those just out of curiosity?
We have.
We look at everything.
Good to know.
Yeah, hard maybe. I honestly feel.
I mean, just because we have to be accurate, we have. We continue to look at stuff like that.
Got it. All right, now we can talk about 2023.
Well, first of all, I want to do a more all-encompassing predictions episode. We should do that to kind of cap off the year. But I also think I honestly am going into 2023 feeling very optimistic, like very positive. And I sort of think it comes across a couple different dimensions, which is there was like a period of time like post Luna when everyone was like, oh, this has got to be the bottom. And Yano and I used to have these conversations where it's like, I don't think so, because everyone's still way too angry. There's like a lot of emotion and angry, and people are engaging and yelling at other people. And now we've sort of entered what feels like this is apathy, you know? And when it isn't apathy, you know what people, so people at the peak of the bull market, this is purely a sentiment-based thing, but people used to get very angry when you would even suggest something negative, right? When you like breathed a word of, possible skepticism about like X, Y, or Z thing, people would yell at you. Now we get a lot of comments on like our YouTube. The best contraindicator is the Blockworks YouTube comment section, because whenever you say something bullish or positive, people get mad at you. They're like not having it, you know? And I don't know, FTX, which is a top 3 crypto exchange, imploded, and we didn't really put in new lows. So I'm kind of just like, I don't know. I feel sort of positive going into the new year, to be honest.
I share the optimism. I read a lot of like financial history, not because like I'm trying to like out macro people. I just like to understand the different cycles and how people felt and all that stuff. And the cool part about the history of finance is that there's literally 250 yerears of data about how things traded, what happened after big collapses, what happened after big booms, and mean reversion is a seriously powerful force. If you look back, it's very rare for you to get smoked twice, back to back, 1 year and then the next. Usually there's some sort of at least relief. And so, when you're up 20 or 10 or 15% like it was in 2021, you naturally get nervous about the downside. But now it's like, I don't know, unless there's centuries of mean reversion data that's wrong, feels like it'll at least be a little bit more accommodative, and washing out all of the bad players, helps to add to that story. The worst thing that we could do is just carry some bodies with us into 2023. I would like to leave those behind if at all possible.
The thing that I'd add, just from a macro perspective, I think from a micro perspective, my quick take is that things are starting to work. Like we're starting to see games that have, hundreds of thousands or potentially, single digit millions monthly active users. Like things are launching. You start to see the revenue numbers of some of these staking options and providers, and like those are working as well from a business perspective. So like the green shoots of the micro side of it are popping through, and I bet that they expand over the next 6-ish months, I would say. The overhang that I'm thinking about right now is what happens once Shanghai goes in. Like that feels like the last piece of FUD that, oh my God, you got 15 million ETH that's about to become withdrawn and sold on market. Like obviously that's not going to happen, but like that's one of the big kind of like variables that I'll be looking to in March when that finally goes through. But I'd say on the macro side, the way that I've been thinking about it, and Vance and I had a conversation this week with a couple of other friends in the space, and basically the stock market has been a tale of two cities over the last 12 months, maybe like the last 15 months, where you've had the S&P 500 is only 15% off of its highs right now. It's not a bear market in the sense of like the global U.S. economy. Unemployment still doesn't budge, even this week with the new unemployment numbers. Like the economy is still working, but the thing that's the other city has been anything that's a risk asset. Growth stocks are down 70, 80, 90%. Crypto is obviously taking a shellacking. And I think what we're going to start to see is like a shifting back of the subcategories of the market that have done well, energy and materials and chemicals, like they've all done really well this year, back to some of the risk assets, some of the growth assets that, just got hurt over the last 15 months. That's probably how I would peg it, but I don't know if, we're going to have like a banner year in the S&P writ large. I think we're just going to have like subsectors doing much better, and the ones that have been doing well, probably a rotation out of those.
Well, last thing I'll add to Michael's point, if you look at Goldman's 2023 outlook, the two top ideas that they have are short the S&P and then commodities super cycle. So they think commodities are going to go up 43%, and they think short S&P is going to net you like 20% or something like that. Same people who were telling you last year that we were bound for all-time highs this year, and that long S&P was the consensus.
Okay.
So
there was all right. So I was actually at the Solana, like the breakpoint, like top signal of all top signals. And I actually remember somebody saying at this crypto thing, because people back then, this was a legitimate thing people debated on. Do you believe in the super cycle? And someone was telling me how...
Do you believe in Santa Claus?
No, someone was actually telling me how every couple of years in commodities, someone comes out and calls it a commodity super cycle. And it never, ever, ever is. And they were like, oh, well, like we see this in commodities, and like that's why I don't believe in the super cycle for crypto. And it's just, at the time, I was like, it actually makes a lot of sense.
Like, you don't understand Suzu, man. You just
You don't understand the logic of the new paradigm.
I'll be honest. I never knew what revanchist was. I never Googled it. I've seen it come up on Twitter quite a bit. I've never looked into what that term meant, but I will forever associate it with Suzu.
Suzu and his big brain. Yeah. I mean, commodities are very similar. Like, I grew up in Canada, and part of my family is in like the commodities business in Vancouver and British Columbia. But like, they were the original people who, there was this one year where oil went up like 2 or 3x or something crazy like that. One of like the rich kids that I knew growing up, his dad bought the Calgary Flames. They won the Stanley Cup. So like you had like the commodity super cycle, you won like the Super Bowl of Canada. And then like there was this whole theory that like, Canada was just going to be the biggest country in the world, and like we were going to take over the Americans and all that stuff. And, a year later, there's bumper stickers around Vancouver and Calgary saying like, Lord, give me one more super cycle. I promise I'll sell the top this time. And like, like getting worked and coming back, like this was a lot of the story of like at least the businesses that my family was in. But it's the same thing. People always think it can go up forever, and then it inevitably doesn't.
Yeah. I'm looking for, there was a chart on the margin. There's a guy named Jurrien Timmer over at Fidelity who does like macro analysis for them. I like that guy a lot. And he showed this chart that basically forever changed how I thought about Bitcoin as a long-term investment. And he basically showed, I'll see if I can like pull it and I was just looking for it on my email, but I switched computers, so I can't find it. But basically he showed like the very long-term returns of cash, gold, equities, like debt, like cash plus debt, and over like long periods of time. And what you can really clearly see is equities crushes everything else. Like it's not even close. There's an enormous gap in between everything. But what gold does over periods of times, it has these like spikes. It has these spikes that like it's because it's the exact thing that everyone says that it does. It protects your purchasing power over a period of time, and it's a hedge against like when there's crazy debasement or inflation or whatever it is. And it just made me think. I mean, it's the thing that people have always said, which is you want your assets to be productive, and it kind of made me think more of Bitcoin as a trade that is like a long-term hold into eternity, because it doesn't compound.
It's interesting. I just looked at the price. Gold's down 6% this year. You know, you're only like marginally better than the S&P 500, where you might get a dividend too.
Yeah. No, I'm with you on the gold thing. It would be tough to own, but
my mind is still blown that gold has a 12 trillion market cap. How does that make any sense at all?
I have a theory about this too, dude. If you go back and look in the history of gold, like the vast majority of gold's gains all came over like two periods of time, right? When they made it legal basically to own again, and then like once in the 70s or 80s, and that crazy volatility, I think it just imprinted on one like generation that you just hold this thing and it goes up forever, and that imprint, that psychological imprint, has carried it as an asset class to this very day.
For like 60 years.
Yeah, for like 60 years. Because people like, I learned my lesson. I don't sell gold. And I just think I respect the people who hold the gold. But that's kind of what I think.
How much of the gold reserves? So gold has a $12 trillion market cap. How much of that is held by countries? Because you got to assume the U.S. has probably. U.S. definitely has the largest gold reserve. I bet the U.S. has like 10% of that. I bet they have like $1 trillion.
I think more than that even.
Top 10 central bank gold holdings.
Oh, can we actually guess at this?
Investinggold.com, which is a real website. You want to go first? What do you think the United States has?
Ooh.
I'm gonna say less than $1 trillion.
Yeah, far less.
Okay. Yano, you want to go for them?
100 billion, I'd say.
I bet they. What do I think they actually have? Yeah, somewhere between 500 billion and $1 trillion.
I think I know the bank that has the most. Can I just skip to...
Yano guessed a range, which was not actually allowed. So you've been disqualified.
Bro, you said 100 billion.
You guessed a $500 billion range. The other contestants put in a specific value.
Smart.
It is $528 billion. And strangely, all right, for bonus, what's the second biggest country?
Russia.
And how much do they have?
One of the European countries, or it's either Russia or it's either Russia or one of the top Europe, or probably Germany. Or
all right,
Germany
I'll give you a hint. It's culturally on the nose that they would have this much gold.
India?
Nope, that is a good guess though.
Germany.
There we go. Very German to hold a lot of gold.
Yeah.
Wow. Okay, that's interesting.
Yeah, very conservative.
Wait, and what do we think they have relative to the? I bet it's 1/4 of what the U.S. has.
Yeah, I was gonna say 100.
They've got about half.
Oh wow. Damn,
$250 billion. There's a good Economist article that's saying
what
how
Russia
all the autocratic nations are buying up gold this year.
Yeah.
So Russia has about 100 billion, quarter of what the U.S. has.
Yeah. They've been buying. Yeah, they've like totally petered off track. But if you're in Russia, I mean, people really disregarded this when we froze all those central bank assets for Russia, and people said, well, look, it's a signal of strength for the dollar. But come on, like put yourself in the position of a nation that does not have their interests aligned with the United States. I mean, you have to be developing contingency plans, right? Is that a crazy leap in logic? Like, if your largest adversary on the global stage can just freeze your reserves at any given time, it's not going to be tomorrow, but like you have to be developing a contingency plan there, right? I would think.
That's what Felix Zulauf Who did
Zulauf.
Zulauf was saying?
Yeah.
I was listening to that on the treadmill this morning. I was like, this is way too depressing. I gotta take this out. He is he's a big proponent of like the autocratic nations are gonna buy commodities and bury them in the ground.
Yeah.
I don't know if that even really matters if it's on the margin. Like these things are so small.
I've been listening to Felix Zulauf for a while. He's pretty on the money. I'm not gonna. If you listen to him over like periods of years, he's pretty good actually. But I hope he's not right because yeah, his predictions have gotten like pretty dire. Although he thinks the bottom is coming in like Q1 or Q2 of this coming year, and then one big up and then big down.
The thing about like all of these guys is like, you know, I remember, when was it, like 4 years ago, listening to Kyle Bass. The Hong Kong dollar is going to zero. We're going to short the hell out of it. I'm getting massive leverage. And I'm like on these foreign exchange sites trying to figure out how I can like short the Hong Kong. It's gone nowhere. Literally the whole trade has gone nowhere. You know, China's going to blow up for the past 10 years. You know, technology's overvalued for the past 10 years. Like, everybody's got an opinion. I just don't think his is like well-founded in reason. Inflation's going down. Like, it's like all of the components negative other than rent. You know, like you can really see it. So I don't maybe he's just smarter than I am, entirely possible, but I don't know where it comes from.
One call out, on the inflation point. I don't know if you guys follow Trueflation.
Yes.
It actually has like a crypto component where they're putting it on chain, I think via Chainlink. But anyways, they've created their own proprietary, and I would argue probably more accurate in real time CPI measure or alternative to CPI. Someone figured out that their predictions and their subcomponent predictions are exactly correct. They're just moved forward 3 months. So I think the October one was the equivalent of the December one, and like they nailed every single component and the top line number. It was kind of a fascinating Twitter thread and analysis, but shout out to Trueflation.
Interesting. Just give him a follow.
All right, guys. Great episode, and we'll see you next week.